Today's stock is going to be Walmart, symbol WMT. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, we've finally got a little bit of chop in the marketplace over the last few days. What's driving the market higher today, though?
Yeah, we're seeing a big update this Monday morning, Brian. And it comes after a week last week that was one of the worst weeks in the last 2 months. So definitely a welcome change in direction in the market this morning. But what's driving it? It's really all about the same things that have been driving the market over the last month. The rebound from that March 23rd bottom. It's been all about the Fed and all about any news that we can find on the development of vaccines or treatments for the coronavirus. And we got both of those in the last 24 hours. So Federal Reserve Chairman Jerome Powell, he was on 60 Minutes last night in case you missed it. And he really got the rally started here by talking about how, the Fed is not out of ammo. They have plenty to do to continue to help support the economy, to return to a normal growth environment once we get past this coronavirus pandemic. He said, listen, I wouldn't count the American economy out here. And the one thing that he did say, though, was that, look, the one thing that can prevent us from having a full economic recovery more quickly would be the lack of a treatment or a vaccine. And guess what happened this morning, Brian? We got news of a vaccine, positive news of the vaccine that Moderna is working on currently. And I don't know if you saw that stock pulled up, but that stock is soaring this morning, up more than 20%, 25%, something like that. It's been a little volatile this morning. But they had positive results from their phase 1 trial, which involves humans taking their vaccine. And they're saying that they're seeing positive results in every single person that was in the trial, and they're building antibodies against the coronavirus. So this is a very big positive news. So I think combined, you're getting the 1-2 pound of the Fed and news on a treatment today that's really setting up the week for a strong start. So that's great. We also got some economic news out this morning that was better than expected. Home builder confidence, mortgage applications actually have been improving back to levels that we saw prior to the crisis. So it seems like, individuals, the consumers are willing to look past this. And that's why one of the stocks that we're going to look at today is one in what has been the beaten up retail space, but Walmart is one of the the outstanding stocks within the retail space, one of the winners, I guess, when you think about retailers in the coronavirus crisis because of their online presence. But I'll get into that in a bit. But this really is the week where we get retail earnings season kicking off in earnest, and we're starting with Walmart. But Brian, I know I got a little off track there a little bit. We were looking at the S&P 500 chart. I think what was really interesting about last week, it got pretty nerve-wracking when the index moved below that 20-day moving average. We've been neither of us are technicians, but we do know and believe that the market has been trading on technical patterns more recently, especially when there's this lack of fundamental clarity about the future and the economic growth that we're going to see in the future. And we broke below that, but this morning we're above it. Where are we at from a technical perspective in your view?
Okay, well, as I had my son's trying to break into my little room right now. But with that said, so I'm chuckling a little bit. But with that said, you're right. This 20-day moving average is where we broke down a little bit, and the technicals have played pretty heavily in the marketplace recently. Now, if I look at the S&P 500 index, I see a little bit of chop going on down here. This is on the low end of it. We're right around. Wyatt, 1 second. I'll be right there.
We can have a third co-host this Monday morning.
Yeah, well, it gives me a little smile. All right. Mommy's got them. We're at 2776 is where it's kind of started that channel. And then up to the upside, we're around 2950. So we see the little bit of chop that we've had over the last few days, going back to the 21st. And right now we're trying to break out to the upside. So if we did get a little bit of a break out of this channel, I think overall, obviously that would be good news. The day is early, so we don't quite know where we're going to finish up yet. But then the 200-day average comes into play. Now, obviously a good sign for the markets, and it's always a good sign to be above the moving averages. And if we can get to the point where above that 200-day moving average, I think overall that's going to even settle down the markets a little bit. I would expect the VIX index to come in a little bit, get down in the 20 range, give us just a little bit less fear in the marketplace if we can start trading above all of these moving averages in the short term. All right, so let's talk about Walmart. Here's the Walmart chart right here, and I know they're going to be announcing earnings in the morning. What are your thoughts on Walmart, Lindsey?
Yeah, so they report earnings tomorrow morning. This is, like I started to say, Walmart has been one of those companies that's been a beneficiary of the changing world in the aftermath of the COVID crisis. A lot more people shopping online, people looking for their low price promise that they offer, and their stores have been able to remain open, unlike a department store where many of them closed all their stores, had to furlough some of their employees. Walmart was on the opposite side of that, so they've been actually benefiting and helping consumers throughout this process, and their stock reflects that. Okay, so you look at the chart. I will say we've seen a bit of a dip there since the end of April into May. But still, the stock is up 7% on a year-to-date basis. That compares to the S&P 500, which is down 11%. The staples sector, which this is a stock that is it's not part of consumer discretionary, it's part of consumer staples, because they sell a lot of staples, and over 50% of their revenue comes from groceries, actually. So the staples sector is down 9%. So these guys are doing really well. Now you compare that to an Amazon, who they are competing fiercely with for that e-commerce business right now, especially in the grocery space or essential product space. Amazon's up 31%, but I think the more recent weakness at the end of April going into May was driven by Amazon's earnings reports. Amazon reported at the end of April 30th after the close. So May 1st, their stock actually took a dip, and I think Walmart stock kind of reacted to that as well. So setting a little bit of a lower base going into the earnings report tomorrow, which is good, but it's going to be all about, as usual, same-store sales. In the U.S. especially, we call those comp store sales in the industry, in the retail industry. They're expected to be up 9 to 10% for the most recent quarter, which is a big acceleration from what they had seen over the course of the last year plus. And that is due to the selling of those in-demand items over the last couple months. But I think what's going to be more important, less so what happened in the last quarter, but what's happening quarter to date for the new quarter. And I think investors are looking for same-store sales to have moderated a little bit in the course of the past month or so since the second quarter started here. So maybe those U.S. same-store sales numbers come down to a 5-6% mid-single digit range, which is fine, but e-commerce, if they'll talk about that, that's going to be really interesting to hear where that's at quarter to date. I think the expectation is still that those numbers are going to be up huge, like 50 to 75% on that quarter to date basis. And then most importantly is going to be, where are these guys at from an expense perspective? Because we heard from Amazon, they've seen expenses increase pretty significantly while they prepare their business to deal with the COVID crisis. So making sure that their employees are able to safely socially distance from each other, making sure that the warehouses are set up for that, making sure there's masks and other PPE equipment for their workers, really taking into consideration the safety of the worker. Walmart's probably going to see a lot of those similar expenses. Amazon saw an increase in expenses for shipping as demand increased. It was really hard for them to keep their 2-day delivery promise on especially a lot of these items, like toilet paper, Clorox wipes, different cleaning products, and things like that. You know, the supply chain was really constrained there. So it was like Amazon wasn't getting the stuff quick enough to send it out to keep that promise. You might hear some of that also from Walmart. People expect that. But the question is, where are your EBIT, earnings before interest and taxes, margins, and your gross margins going in the second half of the year? We get it. You had to deal with this crisis in the first half of the year. Can we see an improvement in the second half? So I think that's really where investors are going to be squarely focused when they report earnings tomorrow. Like I said, the stock base here is a little bit lower going into the earnings report, unlike Amazon, who I think hit potentially a new all-time high going into their earnings report. So it's a little bit better of a setup. Doesn't mean there might not be any pressure, because this is an expensive stock, Brian, trading at 25 times on a forward price to earnings ratio basis. That compares to 21 times for the 3-year average and 18.5 times for the 5-year average. So this is, for a retailer, this is pretty expensive. So we'll see how investors react to it. It's still a pretty high quality company too. Again, though, Brian, before I let you get into your options trade for the day, I just want to remind our reviewers of a couple things. Number one, these are not meant to be recommendations to stocks that we talk about, really just kind of paper trades, ideas, get your mind going. Not a recommendation, though, by us. And for the record, I do own Amazon stock. I do not own Walmart. Brian, I don't know about you. You can give that disclosure. And then finally, if you have any questions, we've got some new technology today, so we're able to take your questions live today. So please type them in the box, in the comment box on the right, and we'll get to them at the end of the show.
All right.
Brian, with that, I'm going to pass it back to you.
Excellent. Thank you so much, Lindsey. I do not happen to own Walmart also. I'll put that in the record. But right here, I'm going to start by just looking at the chart. One of the things that's good about the chart is we did fill a gap. Filling gaps are always good as far as technical analysis is concerned. So if we haven't quite got back up over that level, and it'd be interesting if that actually happened today before the earnings. If that did happen, that would be a good sign just overall chart-wise for Walmart. All right, and so now if we get into the options position here, we're looking at Walmart stocks, and we're up $1.19 on the day today. The earnings date is tomorrow. It's going to be before the open, and we're going to look at a long call spread, and it's going to be speculative, mainly because of earnings. So if you're doing any option trade around earnings, I would term it as a speculative trade. Now, this is just a paper trade that we're going to be looking at, not meant to be a recommendation, as Lindsey mentioned. So we're looking at the 127.15. That is the right now, that's where the current price is at. Now, with Walmart, we have a plethora of different expirations. And if I'm looking at an earnings trade or anything around earnings, I don't even care what that specific strategy is. I always want to know what the expected move is. So the expected move would be by looking at the near-term option contract, the 4-day options. All you're doing is trying to see what the marketplace is saying about Walmart going into earnings. And if you see here, we see the implied volatility. Here's the call option. This is the Ally Invest live option chains. We see the 127 strike is the most at-the-money strike. We see implied volatilities at around 58%. So they're elevated relative to, if you even go out to the expiration that we're going to use today, the 18-day June 5th expiration, that same implied volatility is about 34%. So the marketplace knows about this earnings report. That's why we see that inflated volatility. So now what else can I figure out by looking at that expiration? 127 is the strike. We see that the most at-the-money call option right here, the 127 strike, is trading about 330 on the ask, so we'll call it around 325. Over here, On the bid side, or on the put side, I'm sorry, we're seeing it's 310 on the ask, about 3 on the bid. So we're going to call it about $6.20. And if we do the math on that, that's about a 6% move in Walmart after earnings is announced. That's what the marketplace is expecting, right? That's the line in the sand. That's the over-under. It has no regard to direction, okay? But we just want to make sure that if we're doing a trade, that we're selling a strike that is anticipated that the stock could actually move that amount, all right? So if that all makes sense, let's go back into a long call spread. And the trade that we're going to look at is the June 5th expiration. So we're going to give this trade, even though it's a speculative trade, it's going to have 18 days to live. The thing that makes it more speculative on a paper trading basis is the fact that they are announcing in the morning. And so we don't know what's going to happen after that big announcement. We know what the expected move is. They're thinking about a 6-point move in either direction. That'd be down to 121 on the bear side. On the upside, we're looking at 133. So we want to pick strikes that are contained within that move. That all that is when I'm looking at that expected move, I like to call that kind of the over-under, what the marketplace is saying. And they're saying that if you just buy a long put and a long call at the money strike, this is what we're going to charge you for that. That's the cost of that. So that basically means that is what the marketplace is expecting could happen. That's why we're charging that premium overall. All right. So the 125 strike, June 5th expiration. If I click here, once would mean a buy on our option change. If I click here, twice would mean a sell. And if I go down to our workbench, we see that we're basically doing a 50-50 trade here in that. It's a 5-point wide spread from 125 to 130. And we're going to pay at the midpoint, it says 253. I'm going to make the math simple. Our goal would be to fill somewhere near the midpoint. We're going to say 250. If we could get a $2.50 fill here, then it's literally a 50-50 trade in that if the stock goes up above 130, you're going to make 250, which is 5 minus $2.50. If it goes below 125, you're going to lose that 250. If that happens after the earnings, we still have a few days for it to bounce back, but in concept, if it at expiration it's below 125, that means we'd be down at $2.50. Now this is a 1-by-1 long spread. That's what it would be inside the options playbook. A 1-by-1 long spread. That means that you take that $2.50. You multiply it by 100, what the contracts represent, and it would be $250 for each spread that you put on. And don't forget commissions. You always want to include commissions on that valuation too. So $250 worth of risk. If the market goes up and closes above 130 at the expiration, that would give us $2.50 worth of upside, less commissions on that trade. So that's our official paper trade. So I'm going to click the trade button here, and I'm just going to put it in the right rail. We're not going to send this order. And I'll put $2.50 right here in the net debit to the account here. So doing a long spread, the reason why we want to sell some premium is because we have earnings. And implied volatilities are elevated because of the earnings. They're not as high as back when the big drop in the marketplace just overall and the VIX skyrocketed to above 80% implied volatility. But they are still high relative to last year's valuation. So because of that, we want to buy one option contract and sell one option contract at the same time. All right, so that's the official paper trade. We're looking to buy one of the June 5th expiration 125 calls, and at the same time sell one of the June 5th expiration 130 calls. Our goal would be to fill somewhere near the midpoint. Never guarantee that you'd get a midpoint fill, but that would be our goal. And that price is $2.50. Don't forget to add the commissions onto the trade. And then let's look quickly at the profit and loss graph here. I've got my screen zoomed in, so let me get rid of the right rail for short term. All right, so if I zoom in on our profit and loss graph, we see here's where our risk is. Basically, when I look at a long call spread, I kind of think of, well, from 130 on up, I cannot profit anymore. I'm capped, so I'm going to take my ball and go home. From 125 on down, I cannot lose anymore because our risk is fixed. So from 125 on down, the maximum we could lose is at $2.50 or $250 plus commission. And so from 125 on down, I'm going to take my ball and go home. The only way that I'm playing is between 125 and 130. That's the range of stock prices where this strategy is in play. Now, to start with, we're looking at the multicolored line, right? This is the multicolored line. This is our profit and loss graph as of right now. It's a fairly flat line because volatilities are kind of high and we got a very short-term expiration. But if I change the days to expiration, let's go down and change it. I'll do it to 3 days, and we'll see that line start to gravitate towards the dotted line, which is the expiration graph. So when you're doing this strategy, you're better off if the stock makes that 130 strike, the high strike that we sold, closer to the expiration date as opposed to right away. And that's the difference between buying a call outright as opposed to doing a long call spread. Now, if the stock continues on up, you see that the green line eventually just morphs into the white expiration graph. So obviously, if the stock skyrockets, that's your best bet. It's also the true on the downside too here, that it gives you a small pillow to land on if it's incorrect, and then as you go further down, it morphs towards that expiration graph. All right, so let's now open it up for questions. We had a question from last week, Lindsey, and let me stop sharing my screen here.
Yeah, we had a really good question.
Why don't we start with that? Yep.
Yeah, it was a pretty detailed question. And so it came from David D. I'm going to distill it down because it was very detailed and included specific prices and everything. So it was regarding our trade last week, our paper trade on Square. David D, from what I can tell, what he's really interested in knowing is, can you explain what selling a short put spread is, and then how do you profit from it?
All right. Okay. So last week we looked at Square and we sold a short put spread. That meant that we wanted the market to either stay where it was at or go up. Now, the biggest thing about options, which is sometimes tricky, is that you can sell an option without owning it, but you're selling an option contract. So when you do that, in theory, what you really want is for the option contracts to expire worthless. And that's why we say that you're neutral to bullish, right? If I'm selling a put, I'm bullish. If I'm buying a put, I'm bearish. So in this instance, that underlying stock, it did bounce up and down, but after we talked about the call, it made a fairly decent run up. So you got two different things that you can do here. You can either buy and close the short put and sell and close that long put, and then you're going to pay a small debit to get out of that trade after the stock ran up. Or you can wait all the way to expiration and you hope that those contracts expire worthless. Hence, you would make the net credit that you received when you initially put on the spread. So when I'm selling something for a net credit, like in a short call spread or a short put spread, like we talked about in Square last week, if you think about it this way, if you sell something, very rarely do you get more for it, right? If you go in and you sell a car to your neighbor, very rarely do they drive that car around the neighborhood and say, this is such a great car, here, let me give you more money for it, right? That's also true in the options world. When you sell something, 99% of the time, that means that's your maximum that you're going to get on that trade. You bring in that net credit, you hope the options expire worthless, and then that means you make the maximum from that short put spread. All right. Well, that's going to be it for this edition of the Stock Play of the Day. If you have any questions and you put them in the chat box, we will address them next week. So make sure that you do that. And don't forget to click subscribe and ring the bell so you get all the notifications for all stock plays of the day. And I'll be back on Friday to talk about the Stock Play of the Day Overtime Edition.
Yeah, and the stock play of the overtime, you can't miss it because Brian's going to revisit this paper trade on Walmart on Friday to give you an update of if there needs to be any rejiggering to the trade or if you're good to go until expiration. So it's a really great quick hit show on Fridays at noon, right, Brian?
That is correct. And I think we came up with a word of the day. Rejiggering is now the word of the day. So I think that we can address that next week. Thanks for that, Lindsey. All right, everyone. Thanks for coming. We'll see you same time, same place next week.